stock market is a roller coaster that can sometimes take your soul away. The same thing has happened recently when Japan made some big changes that affected the US stock market. But what happened there? Well, stay with us till the end of the video to find out, because we have a proper explanation for you. Let's get started. The world economy is like a huge, complicated web that links everything together. Things that happen in one country don't stay there. If something big happens in the UK, it might affect the US. When China does something big, it can change what people want all over the world. Everything is linked. So when the economy of one country is doing better than that of another, money moves between them. So let's say you hear that the pizza place down the street's having a great deal on slices. You'll probably go there instead of your regular spot. This is also true for money. People and businesses want to put their cash where it will get the most value. Indeed, the US dollar does not have as much buying power as it used to. It's lost a lot of its strength over the last 50 years, but it's still the world's money of choice. That's right, everyone wants it because, well, it's safe, and people always want stable things. You can think of it as the comfort food of money. It's always there for you when you need it. However, what do countries do with all this extra money they need in dollars? They buy treasuries from the US. Think of US treasuries as an investment that is completely risk-free and backed by the US government. You can feel safe and sure that your money will be there when you wake up. It's like putting your money in a great mattress. Now, every country has its own money, interest rates, and rates of inflation, and all of these are based on how much money they can get in bucks. As a result, there is sometimes an arbitrage opportunity. This is just a fancy word for the chance to make quick cash by buying money in a currency with a low interest rate and then investing in a currency with a high interest rate. You keep the difference, and now you have made money. Now let's talk about Japan. It's been more than 30 years since the Japanese yen has been strong, like a team that tries over and over but just can't get a win. Deflation, an aging population, and low demand have all hurt Japan's economy. Deflation is when prices keep going down and people don't want to spend any money because they think things will be even cheaper tomorrow. It's like a recipe for trouble with money. Japan wants people to spend, borrow, and trade more, so it has kept its interest rates very low. They have kept trying because inflation was not a thing in those places. This wouldn't normally be a big deal because interest rates around the world try to balance each other out. The US then made things harder than planned. Inflation in the US was very high from 2022 to 2023, so interest rates were raised more quickly than ever before. Suddenly, the US had a very attractive interest rate with no danger. It looked like they were waving a big sign that said free money here. Traders saw a great chance. They could borrow yen at Japan's low interest rate, change it into US dollars, and put it in the US. Now the thing is, the worth of the yen has also been going down against the dollar. So when these sellers need to pay back their yen loan, it will cost them less US dollars to do so. In this case, you take $10 from a friend, buy something that costs $15, then only owe $8 to repay them because the value of what you borrowed is decreased. Let's say you borrowed 1.3 million yen with a 0.5% interest rate. You could get about $10,000 that way. You now have $10,000 and you buy a US Treasury bond that will earn you 5.5% interest over the next 12 months. Your $10,000 grows to $10,500 after a year. The interesting thing is that the value of the yen has gone down, so that $10,000 is now worth 1.371 million yen. After paying back the 1.3 million yen loan plus some interest, you have a return of about $500. You got all of this with little risk because you put your money into something backed by the US government. Hence, you already know that you need to borrow 1.3 million yen to get to $10,000. The value of the yen has dropped even more since then, so that $10,000 now only gets you 1.5 million yen. That's a great deal, right? Since the US dollar gained value against the yen, you not only make your $500 profit, but you also get an extra 200,000 yen for free. Japan changed things up just when it looked like everything was going well. They raised rates of interest because their currency was losing value and they wanted to stop it. Because they did something, the yen began to get stronger while the US dollar began to weaken. Take out a loan of 1.6 million yen to get to $10,000, and all of a sudden the dollar gets weaker and the yen gets stronger. Your $10,000 loan only gets you 1.4 million yen when it's time to pay it back. Oh no. Now you're short 200,000 yen and you need to quickly find that money somewhere. This is where things get tricky. $1 was worth 161 yen on July 10th. That same dollar was worth 143 yen before Japan raised its interest rates. That's a loss of more than 10%. And when trillions of dollars are changing hands in the markets, that's a big big deal. It's like a very big game of dancing chairs where some people are suddenly out of seats. People start to worry and sell their stocks to cover their losses, and before you know it, the market is falling like a rock. Japan's market lost more money in a single day than it did since Black Monday in 1987. The US stock market would have dropped 133% in one day, to give you an idea of how scary that is. Some people might wonder why Japan would raise interest rates if it was going to make things so bad. They had to, after all. It costs more in yen to buy things from other countries when the value of the yen goes down, and this made their currency fall even more, so they raised interest rates. A lot of people sold their stocks in the market because of what was going on, which caused more fear, which led to even more selling, and so on. It keeps going and going. This is not a one-time thing, though. There's more going on here. Besides all of this, people are also scared about a slowdown. It was said last week that U.S. businesses aren't hiring as many people as they thought they would. It was even said by ZipRecruiter's top economists that the job market is no longer normalizing. That's right, things might get worse. When businesses cut jobs, people spend less, which means they make less money, which means more jobs are cut, and it's going downhill. Recently, the price of a barrel of oil dropped to $73. This is because people are afraid that demand will drop and unemployment will rise. That could cause exporters to cut back on production, which could have effects that last for a long time. One reason Warren Buffett might be moving is because of this. You know what? That guy's playing chess while the rest of us are, well, still trying to figure it out. When we talk about Buffett, he recently sold $84 billion worth of Apple stock. It was said just before this that Google may have broken antitrust rules, which could hurt Apple's profits. It's almost like Buffett could see into the future because he sold just as things began to look bad. But he not only sold a huge amount of Apple stock, but the sale happened at just the right time. Some people think that the Federal Reserve should start lowering interest rates to slow down the damage caused by all of this chaos. The stock market's gone down every time the Federal Reserve has cut interest rates since 1990. We know that sounds wrong, but let me explain. Fed cuts rates only when they think big problems are coming up, so it's usually a sign that things are going to get tough. It's a good warning that anything can happen in the market. Things could get worse before they get better, but they could also get better again. It's important to stay cool, plan ahead, and not decide anything on the spot. Now, time for some useful tips. First, you should always have 3 to 6 months worth of costs saved up in case of an emergency. They will not have to be sold at a loss if you lose your job or need cash quickly. Next, spread out your investments. It's like not putting all your eggs in one basket. Spread your money out among stocks, bonds, real estate, cash, and other types of assets. And that way you can fall back on other investments if one fails. Even when the market's down, you should keep buying if you want to make money in the long run. A method known as dollar cost averaging can help even out the ups and downs. Also, don't sell right away when things look bad. Fear can make you want to sell, but if you do, you might miss the rebound. Don't forget that the market has always come back from bad times, even if it took a while. To avoid having to sell your investments when money gets tight, make sure you have a steady source of income. For peace of mind, keep some extra cash on hand. There may not be much attention on it, but it can help you sleep better at night. And last but not least, the stock market might not be the best place to put money if you need it soon. The market's not always stable in the short term, but it does tend to grow over time. So what's your take on this drop? Share with us in the comments section below.